Hi there. We're back with another episode of Finding Proof. And today we're excited to have with us Paige Soya of K Street Capital, based in Washington, D.C. Paige is a managing partner at K Street, and the fund is primarily investing in seed stage venture opportunities in high growth regulated markets like fintech, health tech, and climate tech. Although in the last year or so, they've added another piece to their strategy, which is managing a fund of funds program that the DC government has put together. So I'm sure we'll talk about all of that. So maybe we can start, Paige, with having you tell us a little bit about K Street and how you like to describe the things that you guys do.
Yeah, I'm happy to. And thanks for having me on the show. It's great to see you guys. So I think for those that don't know, K Street really started out originally as an angel group, so myself included. So a bunch of angels pulling capital together to do direct deals in early stage companies that were in regulated markets in Washington, D.C. And largely that was because a lot of the investors, either they were ex-regulators or they worked on the Hill or they worked in policy or public affairs, and they had a very strong pulse on those markets and the direction that things were going to go in those markets and where there might be opportunities to make investments in early stage companies. So that was the genesis of it, and that was 11 years ago now. I think that was in I'd say like 2013 is when we did our first sort of direct investment, and we still do those today. So I think we've made over 120 investments directly into early stage tech companies. And then later, as we sort of grew up and got a little bit bigger, we also launched our own venture capital fund. So we invest out of our fund. We also continue to invest out of our syndicate doing direct deals. And then we also, like you mentioned, we recently, our final, sort of like the trifecta of our platform, the final piece has been this fund of funds program because we we were investing in startups directly, but we were also sometimes investing in funds. Actually, like Proof, for example. I think that was originally how we met several years ago, and we realized that we liked that strategy, and there were a lot of funds that were doing stuff that was very complementary to us. And but maybe it was later stage, or it was in different sectors, or whatever. It was something that we weren't getting exposure to, or we didn't have the expertise to get exposure to. And so now we actually properly have our fund of funds vehicle, which is a partnership with the District of Columbia. And effectively, it invests in early stage venture capital managers who invest in early stage tech companies in DC.
That's quite the progression. Let's start maybe in the beginning. What prompted you? And you started this network, right, of angel investors originally.
Sort of. So it's an interesting story. It started 11 years ago, and I wasn't part of it then. Back then, it was really just a bunch of investors. It was barely even an organization, you could say. It was really just a bunch of people that wanted to invest in certain companies, and they couldn't do it on their own with their own check size alone. And then I came in as an investor, but also like to manage the group and kind of professionalize it because they had made some good investments before I came, and I think I want to say there were like 20 or 30 deals that had been done before I got there. And but it was just like it was like a volunteer-run messy angel group. There was no fees charged on any of the deals, so there was no incentive for anybody to manage it or like handle any of it. And I, at that time, this was back in 2018, I had just sold my fintech company, and I was trying to figure out what I was going to do with my life next. And I was mentoring a number of other founders like myself who were, had founded high growth venture backed companies, mostly in fintech because that was sort of my background at the time, but also in other industries. And then I found K Street, and I was introduced to Rich Leggett, who I'll tell you about him later, but he's my partner now full time. But he was the original founder of the group back 11 years ago. Him and probably 8 or 9 other people. They really were the first people to sort of like put one of these deals together through and create the entity K Street Capital. And then I was the first person to ever really like I think manage it in sort of like a full-time professional capacity and turn it into more of like a venture capital organization.
And I think that's about the time when we met, right? And were
I think
introduced to
so.
some of your members. What is it like? I mean, do you feel that these syndicates are effective in kind of finding opportunities and kind of screening them, or do you feel like it needs to be more managed. Obviously, you're doing that, but how what's the dynamic like, and what kind of backgrounds do these investors have? We've seen a number of these, and obviously Silicon Valley has a number of them. How does that work?
It's a great question. And it was actually the perfect sort of meeting of the minds, I think, when I came in, and the investor group that was already created at the time, because the investors, they had incredible networks and deal flow. Like they knew a lot of founders who were starting really important businesses at just the right moment in time. And so they had access, but they had no idea how to diligence a deal, or how to know if it was, like if the valuation made sense, or like if it was going to be a good investment returning money to them ultimately. Like they could certainly identify, and they had the access to get into some of these companies, but they couldn't really, like, they didn't really have the expertise to do that, and also they didn't have the bandwidth either. These were all people who were running their own companies, or they were C-suites in public companies, and they just didn't have the ability to do that. So when I came in, I was doing a lot of that on my own with one other person that we hired, just to try to like professionalize it and actually like look at the financials, and try to understand the trajectories of the companies and the cash flow, and their cap tables and the valuation, and then decide from that pool of, like, I don't know, every month back then we got like 10 good deals that were referred in. This was early days. We were a lot smaller then, but we'd get like 10 good deals, and then it was sort of like my role to figure out which one was the best one that we should actually, put our money behind that month, if
Got
that
it.
makes sense.
And has there been an evolution in the investment opportunities that you're seeing? Are they mainly centric around the Washington, D.C. area? Talk to us a little bit about that.
Yeah, it's been an evolution for sure. So I think when I first came, there was a big focus on regulated markets, but the group had kind of gotten away from it. And like if you look on our website, you'll see we've invested in all kinds of stuff. I think we had invested in some food and beverage companies. We had done some consumer. It was kind of all across the board. But again, I think that's because there was no structure, or there was no diligence process. There was no real way. It was kind of like whatever company resonated with them that they liked the best is what they would choose to invest in. And a lot of those were good bets, by the way. I'm not knocking their how it all happened before I came. But it became a very generic thesis. And when I got there, it was sort of like, we really need to hone this in on the things that we're best at. And so looking at the deals we had done and the access that we had from the existing members at the time and today, really our best deals had been in regulated markets. So like ID.me was one of our early investments, and that's a unicorn company. It happens to also be based in DC. Arcadia is another one that was an early stage company that was sort of like in the renewables space. And when we looked at all of across the board, it was very clear that those were the deals that were the winners for us, and those were sort of the areas that we should focus on moving forward. So today, that's what we do. We only focus in regulated markets.
What's your view of kind of the changing and ever growing evolution of the DC venture ecosystem?
Oh yeah. And we invest all across the country, by the way. I should just mention that we happen to be very DC focused, and our name is of course K Street Capital, and we have a big presence here. But about half of our deals are outside of DC, outside of the DMV area, all in the U.S., but not necessarily all in DC. And the DC ecosystem, like I can tell you from my experience having been a founder in the DC ecosystem and raising money in the DC ecosystem for my own startup, and then also investing as an angel, and now as a GP, it's changed dramatically in the last 10 years, in my opinion. I think there it was a very fragmented environment back 10 years ago. Like, I don't think anything was connected in a way that made it seem like there even was a venture ecosystem here. Like, I didn't even think there was one when I first moved here. And today it's very connected. There's a lot of there's like when we started our fund of funds program, people were like, "Well, how many fund managers are even in DC? Like three?" And I'm like, "No, there's like 200 venture capital fund managers in this area that people don't realize. They may not be exclusively focused on DC, but they're here. And because there are more of them and there's more companies popping up here, it's really grown." And then lastly, like the district has realized that and has seen sort of the proof, right? Like in this ecosystem with companies like ID.me and Arcadia and things like that. And they've now doubled down and invested in it. And I think we're going to see big returns from that over the next 10 years as well.
What do you think is the unfair opportunity that a founder may have in DC, or the unfair advantage? I mean, obviously, this is the seat of the federal government, so you can imagine that certain companies addressing regulated markets could have an advantage. But at the same time, you also have West Coast companies trying to come here because there's, the DoD is a big buyer of commercial products now, and so on and so forth. And how do you pitch DC as a market to entrepreneurs if you had to?
Yeah, well, I mean, first of all, I would say it's a great place to live. That people don't realize. Like a lot of our portfolio company founders and CEOs have actually moved to DC, not because of us, but just because they wanted to live in this area, in the DMV area. It's a great place to have a family and raise kids, and it's just a great place to live. Um, but from a business perspective, I think, of course, if you're a company that's selling to the government, or maybe you don't know how to sell to the government, or you're interested and you think you could sell to the government, being here makes that a lot easier. It's a lot easier to connect with the right people to figure out the go-to-market strategy around that, if you're local. And then also, it just goes back to our thesis originally, like the having a pulse on the unregulated markets really matters if you're in a regulated market as a tech company, especially as you're scaling, because a lot of these policies, like you can influence them and have a say in them if you want to, if you know about them and it matters to you. And I think that's why you're seeing a lot of these bigger VCs and other, startups coming here and having their like DC satellite office, because they know how important that is going to be to the life cycle of their business or their investments.
And how many current members are there as part of K Street Capital?
So I think today we have about 120 syndicate members,
Right.
and then we have another 47 LPs in our fund. Yep,
Yeah.
and they're mostly local. I mean, about
Right.
80% of them. Yeah.
Right.
So talk to us a little bit about this fund of funds business, which I think you won it in a competitive RFP process, right?
We did. And we just launched it in December of 2024. So just about a month ago. And we're super excited about it because we've kind of advocated for this for a very long time with the district, and seeing it come to fruition is incredible. But we did win it in a competitive RFP process, and basically we are the manager of the fund of funds program. So it's a $26 million program that's federally funded through SSBCI funding through Treasury, US Treasury, and they basically give that money to the district, to DEMPED, and then our agreement is sort of with the district. So we end up managing the money, selecting the managers, sourcing and selecting the managers, and handling all the reporting and compliance around that, just like a normal fund of funds would, but with a little bit different compliance because it has to have Treasury, SSBCI certifications and things like that. But it's awesome because it's a great way for like fund managers don't have to exclusively be investing in DC to be a candidate for the program, and I think a lot of people don't realize that. But we want to find managers who are experienced managers, not first-time managers, but who have a track record and who have invested in DC, or who have a very good connection to a DC pipeline that they want to develop more and continue to invest in. And basically, the funds we give them just have to go into DC companies, if that makes sense. So they can have a much larger fund that's investing, all across the country, but the portion of capital that we give them goes into DC companies.
How do you thread the needle of, on the one hand, you obviously want this thing to do well and perform and be self-sufficient over time and be successful. On the other hand, there's kind of a geographic, component to how you want the funds that you go into to invest. So how do you balance that? And do you think, did you look at other comparables in other areas, or how have you approached that in your discussions with the DC government?
And let me make sure I understand. Do you mean like the balance between for a fund manager who's thinking about their total portfolio return?
No,
And
I mean for you, right? Because you obviously want managers to invest the dollars that you give them in DC, and that may speak to certain preference. If somebody obviously is only prospecting the DC market, that makes sense. But for somebody that, in other words, do you lose good funds because they say, hey, I can't make specific commitments to certain geography?
Yeah, I think that's a good point. I think there are some funds that are just not a fit for this, right? Because they're not connected to DC. They don't want to be, they're not near it, they're not interested in it. Um, and they might be a great fund manager, but they're just not, they're just not a fit for this. But from the conversations we've had with fund managers so far, I mean, like I mentioned earlier, there's actually quite a few fund managers that invest in DC, and the DC market has kind of exploded from a creating startups perspective in the last 10 years. There's a lot of good companies here, investable companies. And so I think for managers that do have a connection here, have invested here, it's pretty easy to thread the needle in terms of them feeling like they can get good returns, even if they're committing to this area.
Having been a founder and obviously now an investor, what do you think are some of the overlapping characteristics that are required to be skilled at both?
That's a good question. I would say I think that I think that sometimes founders don't realize that VCs also have to fundraise. So fundraising is super important when you have an early stage startup, and being well capitalized and choosing the right investors and just making sure that you have that structured the right way matters. It's the same thing for a fund manager. Just the ability to do that and to develop that network and that muscle is super critical. But also just hard work. I mean, it's
Right.
may seem like a glamorous job from the outside for a lot of people, but it
Yeah.
is, not glamorous most of the time on the inside. Of maybe you guys feel differently, but
Right.
it's a lot of hard work, and just being willing to put in the hard work to find the right deals and not, not compromising on that. I think is super important.
Yep. No, exactly. And then I guess like in tandem with that, like what are some of the more intangible characteristics when you look at, I mean, there are some overlapping similarities too, when you're looking at an investment opportunity in terms of a deal, and then you're looking at obviously an opportunity to invest in a fund. Or what are those some intangible characteristics that are part of your analysis for the fund investment?
Oh, you mean when we're investing in a company
Uh,
through our fund?
for the fund investment for the fund of funds, this new
Uh,
strategy.
okay.
There's some
Yeah.
of the, because obviously you're looking at the metrics, you're looking at the track record, you're looking at a bunch of different characteristics, right? That I think we're all certainly knowledgeable about. But what are some of the more intangible characteristics that you're looking for in a team to deploy capital into?
Yeah, I think the team dynamic really matters. And I don't know if this counts as intangible, but a team that's been together for a long time really matters. I think it just shows that the dynamic of working together has been successful with that track record. Because if you see a team that's different, the track record they're representing isn't necessarily this representative of the new team, if you will. So I think just cohesiveness of the group of people really matters.
Right.
Um, and 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 yeah, I would just say diligence. Like when we interact with this is kind of like when we interact with founders, it's we want them to be diligent with us. So like the way they answer questions in our diligence process, like the way they answer questions matters just as much as what the answer to the question itself is.
Right.
Just because we want to know how they're thinking about things and how organized they are and how responsible
Right.
they are. And we do the same thing with fund managers. So that just tells us a lot about the fund we're investing in terms of how they interact with us in our diligence process.
What kind of things are you looking at right now in terms of kind of investments in companies? Are you excited about specific sectors? Obviously, regulated industries, but do you have a thesis you're pursuing? How does AI play into that? How does kind of the whole change in politics maybe impact what you do, if at all?
I guess I would say right now, well, the overall thesis of K Street being regulated markets is kind of nice for us because it allows us to choose the regulated market that makes the most sense at a given time. So there have been times where we focused more heavily on like, ed tech, for example, and today we don't invest as much in that space. Just because of some of the changes that have happened. But when we look at like today, we're seeing a lot of interesting deal flow in health tech, and especially women's health. I'm sure you're probably seeing that too, which before it was very heavily undercapitalized and also just not necessarily, like a lot of the companies we were seeing weren't really attacking things in a way that made sense. And today there's a lot of policies that have changed that makes these companies even more relevant and easier for them to grow, I guess I would say. So that's definitely a space we're excited about. I would also say, of course, AI. Like AI is amazing. Every company we talk to is using it somehow, and whether or not that's like there, we don't necessarily. It's really hard to invest in like core AI companies right now, and we've done a couple of them, but just trying to understand which ones are really going to win in that space versus like trying to tell the signal from the noise is tricky. But I think we are seeing the effects and the benefits of AI across the whole portfolio in all of the spaces that we invest, which is really exciting, I think, for venture overall.
Speaking of AI, and we've asked, well, we just had this conversation as as it seemed today. Maybe it's too soon, but how have you embedded AI into, either part of kind of the deal flow mechanism, or evaluation of the fund or for investment opportunities, or really in any capacity?
Yeah, I'd be curious what you guys are doing too, because this is an ongoing discussion at our firm, and it should be at all firms, not just VCs. I think right now, but we have a standing meeting every week with our team, and where we go over whatever like the important. It's like our weekly stand up, and it's like an hour long, and we have an entire section that's, I don't know, maybe we spend 5 minutes on it, but we have a section of that agenda every week that is like, what AI tools have you seen and tried, and like, should we be trying, and or did you try from last week, what did we think about them, like how are they working. And I think that's been great, but it's also, we've evaluated a ton of tools that were terrible in the end and didn't really add any value, and this just kind of like it was not really. It's easier still to do it yourself. From a diligence perspective, we're not really using it for like we haven't really found a great tool for like data room organization and sort of like querying, especially when it comes to financials and cap tables and that sort of thing. Um, but I will say, like and probably everyone says this. This is probably not new, but the tool that we found that we're the most excited about right now is called Granola AI, and it's a note taker, but it's a kind of like a hidden background note taker. So no matter what type of call you're on, it just kind of runs in the background. It doesn't sit inside a Zoom call or like a Google call, like how you would see it, normally
Right.
these other note takers. Yeah, so it's like entirely internal, and it records the meeting transcript, but then it also creates notes, and you can be typing your own notes into it at the same time. So it keeps your notes and the AI, like it makes your notes better, like remembers all the things. So you don't have to write everything down. And then it has a link at the bottom to the conversation that you can actually query. So like if you're like later when we're meeting as a team and we're like, oh, what did the founder say about their month over month growth rate? Like, I don't know, let's just ask Granola because we have the transcript, and we just ask it, and it tells us exactly. So it saves a ton of time.
Is it on during the whole day, or is it only you turn it on for meetings?
Only for meetings.
For
I mean, I
meetings,
guess
yeah.
you could turn it on the whole day, I guess, but we only use it for
Yeah,
meetings.
we use Fireflies, which is pretty similar. I mean, very efficient. So it listens in, it automatically creates a summary, and you can always query it as well. And then it sends you. You can always go back at the record. It actually, we like it because it records video as well. So sometimes when there's data shared on the screen, that is not always captured verbally. So that's pretty useful. But our perspective, so we had this debate today actually in our partner meeting, and we're trying to figure out how do we move forward and incorporate a lot of the AI tools. And I think ultimately the conclusion that we came to is that it's good to make ourselves more efficient and better. I mean, obviously, on an individual basis, you have an associate or an analyst who's doing a lot of research. Can you remove a lot of human labor that is kind of devoted to small tasks, and then turn it on to like the things that matter, right? Like judgment. Get a lot of the information and then use judgment. And so I think, whichever firm doesn't follow down that path, I think is gonna be at the disadvantage in the future. That's kind of our sense of it.
100%. Yeah, I agree.
But Thanasis has done a great job at leading the charge for how to, we can improve at proof, certainly. And just,
It's great.
yeah, so I definitely want to say that.
Thank you.
It's awesome. You'll have to tell me all the tricks later.
Yeah, we can compare notes. Let's switch maybe gears a little bit. Do you want to talk to us a little bit about you, your background? I mean, we talked a little bit about being a founder. How did you go into entrepreneurship and how did you go down this path?
Yeah, it's funny, I posted something about this on LinkedIn because I think venture is, we just hired a couple of people recently, and venture is like one of those industries that so it's very competitive to get into, and there's a lot of people that want to get a job in venture, and like, how do you do that? There's so many different paths in to venture that there's, like, you have to figure out what path really works for you. And I would have never told you like 10 years ago, or when I was in college or getting my MBA, that I was going to go into venture. I would have never even, it wasn't even on the realm of options of things that I thought I wanted to do at the time. So my path is definitely unconventional. But I worked in finance in my early career, so in sort of portfolio management and public equities, and ultimately ended up leaving to found a fintech company. And it was a fintech company in the payment space, which was something I was interested in at the time. But at the time, I was working full time. I was getting my MBA nights and weekends, basically, and it was an MBA school project that I was just doing for school that I was interested in and passionate about, but I didn't really wasn't expecting it to turn into a career. But ended up winning a business school competition, and got like a decent size of money to go actually like start it. And I was like not expecting any of that, so I was just like, okay, great. Now I have to figure out like, what am I doing? And I still have my full-time job, and I'm getting my MBA, and somehow I'm starting this company on the side. Like, what is this? So I decided to give it a shot, and the first few months ended up being pretty successful in just raising, a little bit, just enough money to be able to build an MVP of a product of um, what we were trying to, what I was trying to create
And
at the time. And I
what were you
thought,
trying to do out of curiosity? What was the project?
yeah, so this was really before mobile payments took off. So essentially, it was a way for your phone, like Google Pay and Apple Pay and all of those things, didn't really, they existed, but they didn't really connect to anything, not physically or digitally. Like, you couldn't really use these wallets anywhere. So they were kind of useless in the US. And so I wanted to create a company that could connect the rails for all types of mobile payments to either like a physical POS system or digital, like e-commerce type websites. And so that's what we did, actually. And the company is called GoTab, and it still does that today. It's based in Arlington. And so getting off the ground was just I think the challenge for all founders. But that was, for me, I just decided that there's never going to be a time in my life that I would have this opportunity. And I figured, like, if you have the chance to do something like that, and you have the bandwidth in your life to do it, you should take the chance. Even if it fails, it's still going to be worth the learning experience. And it was. I mean, it ended up being successful. We ended up raising money. I ended up leaving my job at Brown Advisory at the time, which was a really hard decision because I wasn't paying myself, and I'd put all of my own personal resources into the business. So I was kind of like sleeping on my friends' couches and trying to put this whole thing together in the background. Um, but it ended up becoming a real business, and I ended up moving to DC because of it, because we had a number of investors and customers in DC. Um, and um, and yeah, we got it to the point where we had sort of like a one of our internal investors, that sort of like was a PE, wanted to take a larger percent ownership in the company, and basically bought me out and a number of other people. And the company, like I said, it still runs today and it does well. But it happened very suddenly. Like, this was a 5-year journey for me, which most founders think it's a much longer journey. And when it happened to me, I was sort of like, I don't know, what am I going to do now? Again, like, I have no idea. I need another job or start another company, but there's nothing I'm passionate about right now. So I'm just going to like try to support other founders on their journey for a little while and see how that goes. And that turned into K Street Capital, right? So that's how I ended up doing this. It just sort of happened by accident, maybe, or organically. But it's been an incredible journey, I will say. It's a lot of fun.
What were no, it's an incredible story, and congratulations on that success. It's amazing. What were some of the biggest learned lessons, particularly from getting it off the ground, like the early days?
For me, I mean, having a finance background doesn't really make you a VC either, by the way. I mean, I'm sure you guys know this, but for the audience, like finance is a hugely broad category, and there's a lot of nuance to each different, you know, aspect of it or niche within it. And I thought that I was like, I'll know everything about venture capital. I have a finance background. I'm an MBA in finance. Like I know what I'm doing, but I didn't know anything about venture really at the time. Like I didn't really understand cap tables or like how much equity I should or shouldn't have been giving away, how I should have structured each of the fundraisers. I didn't really understand any of that. Of course, like I would read something on Google and think that that was enough for me to really like to know. But there were definitely some learnings, some mistakes, and some learnings in that process. And the other thing I'll say too is like I'm not tech. I don't have a technical background, so I ran through three co-founders before I found the right one who was actually really good. It's very hard to like interview and assess talent in someone in a subject that you don't know anything about really. And so that slowed us down tremendously, and I think we wasted a lot of time and dollars in our product that didn't need to be wasted because I made the wrong decision, with my team in that aspect. So that just goes back to what we were saying, like the team dynamic matters so much, and having the right fit and finding the right people it's key.
I mean, you started when really it sounds like out of business school basically. And so how did you, and it's hard to, I mean, even with experience to sometimes start this, how did you go about building a network of people that could support you? Like, what was that like?
I think it was really hard. Like I think I made a lot of mistakes with the wrong people, thinking that I was in the right network at the time, and I was sort of like stumbling my way through it realistically. I think there's some people who maybe they have a more natural ecosystem or a more natural network than I did at the time. I wasn't from a super wealthy family, and I didn't have any entrepreneurs in my family or anyone in venture, so there was just no natural connection point. And I got like I just kept trying, right? Like the more you try, the more you find eventually you get to the right people, and then once you find the right people, that you can kind of exponentially increase your network through those people at that point.
Was it through investors initially that you got connected to people, or was it through service providers, maybe like your law firm? I know that in our communities, sometimes law firms kind of play the connector role.
It was definitely so the probably one of the best early connections I had was my lawyer, which was Mike Lincoln at Cooley, who everybody in this area knows. Yeah,
He's
he
the right
was
guy to have, right? Yeah.
right guy to have. So definitely that was a blessing. I don't even know how I got connected to him, but that was a blessing. And then it was a lot of accelerators, and I think like I don't know or incubators that if there is the right word, but there were a few groups like that that would connect you to advisors in different topic areas, and that was really my original entry point, I think, to the ecosystem. I think that is how I met Mike, actually, now that I think about it. It's a long time ago.
What are some other things that people might not know about venture capital or what it takes to be successful in venture capital?
It may sound silly, but it's really important to take risk and to be comfortable taking risk if you want to work in venture capital. Um, I think that getting started in it, like building your own track record requires you putting your own money into things that you might completely lose, and having a comfort level with that is super important. I think it's what it stops people a lot of times from getting through the door and getting into venture because they're not really they don't really trust themselves enough to make those kind of bets and to make those kind of decisions. And that's something that you have to continually do over and over again in this industry. I mean, you guys know.
What's your favorite thing about living in the DC area?
There's more restaurants than I'll ever be able to go to, which always drives me nuts. Like I'll never be able to get to them all. So that's a plus. But I think it's the people. Like, there's a lot of really great people in DC from lots of different genres of types of work. It's not really like, I guess some people complain that it's a government city, but I don't really even I don't see that at all. From my perspective. And it's just you have a lot of people coming in that are super passionate about whatever they do, and especially with politics and things like that. They may start out in policy or in the White House, but then they end up leaving to do other things, start other companies or other projects that they're passionate about. And I think being surrounded by people like that in a city is just it's inspiring, and it's a really nice feature.
Yeah, I find that it's actually a very cosmopolitan city, obviously because you have the embassies and people come in and out all the time from other countries, but also, people from across the US, right? Like you mentioned, either politics or nonprofits, which there's a gazillion in DC. So it's always now. So that's part of the complaint is sometimes people say, "Oh, people are transient through this city," but a lot of people stick around, like me.
Yeah, exactly, like us.
Yeah, exactly.
But that's kind of nice, right? It gives you some flavor. You always have new people that you can meet and learn from. It's always changing, and I think actually I see that as a benefit. Like you have your some core people that are always here, and you get to develop deep, long relationships with them. But then there's always that continually um, evolving in and out group of people in DC, and I think it's a benefit.
Well, since we're talking about DC, it would be amiss for us to not ask about policy issues related to VC. So, since you've been around policy, is there something that you would change or advocate? And NVCA is based here, which is the National Venture Capital Association. So, what are some of the things that you would like to see changed, maybe?
There is one thing that I've always felt pretty strongly about, and I don't have the full solution to it yet. But if you ask me in 10 years if I was successful in anything related to policy, this would be the one thing. I think there's this innate problem in venture capital where fund managers don't allow for companies to be recapped early enough. So there's like lots of really good businesses that they start out on the venture capital train and they think that they're going to be super high growth, but they just aren't, right? Most of them aren't actually, but they might not be bad businesses. They might still be really great businesses that are doing something really important for society and for our country, and they can be profitable businesses, but they just don't meet the venture capital return requirements that we are looking for. And I think you see fund managers basically don't want to take, they don't want their returns to look bad to their LPs, so they just continue to invest in these companies at high valuations that don't make sense, they'll never grow into, and they keep that up until it's impossible for the company to get out of it from a cash flow or whatever perspective, and then it basically either bankrupts the company or it destroys the founding team. They all end up leaving because they don't have enough equity, and then new investors come in, and everybody loses in this scenario. Basically, it's like you're just delaying something and making it worse than it could be. And so I think that there's something there in terms of a policy that can incentivize fund managers to take those losses and recaps earlier, to enable businesses to continue to thrive if they can on a different path that isn't venture. But I don't know what the answer there is, but that's my thing.
I'm not sure what you would do. I mean, it's an interesting one, right? But I'm not sure what you would do as a I'm trying to think through, does a policy maker have any tools that could make it easier for people to be able to recap? I don't know.
Yeah, I think it has to end up being some sort of like tax favorable incentive to a fund that doesn't exist right now that might encourage them to just make the decision earlier. But I
Right.
don't know exactly what the perfect policy. I need to speak with more policy people to figure that out.
No, it is really interesting though. And that is a first, which we appreciate.
Did you guys have to become a registered investment advisor to be able to? I think you have to, right, to be able to invest, or did you set up a separate entity to manage the fund, or how did you handle that?
Yeah, the fund is a completely wholly separate entity that's registered. That's right.
The fund of funds, right?
The fund of funds and the fund. Yes.
Was that expensive to do, or?
I'm trying to remember now. I mean, I would say it was expensive, but I think it was less expensive than it could have been, probably.
Got it.
Um, it wasn't like a super fun process, I could tell you that.
I believe that.
Yeah. I mean, maybe that's another policy thing that would be something to think about.
Great. Well, Paige, thank you very much for joining us today. Really appreciate your time and your insights. And we look forward to working with you in the future.
Great. Thanks for having me. It's good to see both of you. And I really appreciate it. This was fun.